Lance Roberts here with Thomas Thornton from Hedge Fund Telemetry, hedgefundtelemetry.com. Be sure and check out the website. Great resource of information as always. We've had Tommy Thornton on the show many times to talk about the world at large, the economy, and kind of where we're headed. And Tommy, first of all, welcome to the show. Appreciate you having here.
Okay, well, I'm social distancing, but I'm going to take this off for we're good. It's just a crazy world we're living in, and we've had conversations over the last few months, and I think you and I have been really in alignment that the markets, the economy, just wasn't set up for any sort of sharp object to come near the bubble that the Fed blew up last year. I mean, if you think about it, this is just amazing to me that the Fed was cutting rates at all-time highs last year just to pump this thing up even higher.
Right. And
the market went up on the Trump Phase 1 trade deal, which is completely a nothing.
Right.
So, look, we've got now something that's unprecedented. It's scary. It's affected everyone. It's not just market participants. It's our families are nervous. We have, my mom, I've kept her in super isolation, and we're in a global, unprecedented panic right now.
Tommy, you bring up a good point here, because this is something that we've talked about before, talking about this, this bubble that the Fed created, and for a decade of zero interest rates, massive amounts of liquidity. We inflated probably the largest financial bubble in the history of all the other bubbles they've created. And it's interesting now that people are saying, well, this is just a virus, right? So this is like 9/11. It's just it's a single event that's hitting the markets. And once this is over, we're all going to be fine. And if you take a look at GDP estimates, right? Terrible GDP growth in the second quarter immediately rebounds back to positive growth by the end of the year. I can't really fathom how they're getting to this point, because this is not a singular event like 9/11. This is a credit crisis of a tremendous degree, larger potentially than what we saw in 2008. And that's why the Federal Reserve is acting so aggressively here to bail out basically everything.
Yeah, you're right. During 9/11, it was a scary time, and air traffic was shut down. The country was shut down basically for several days. Not restaurants though, and not small businesses. They stayed open, and I know a lot of people, they soothed themselves by going to restaurants, eating and drinking, and trying to stay normal. This is something that has caused a lot more damage, and the damage across the board is really significant. Now, on the positive side, I will say, yes, this is a transitory issue. It's probably going to be a lot longer as far as the knock-on effects and the lives and businesses that will be affected by unemployment, business closures. I've heard a lot of people already struggling. And it's something that I can't say that we're going to quickly rebound in the second half of the year. It could last a little longer. It's going to be really, really bad, the data coming out. And when this airs, the non-farm payroll number will probably be coming out right after, and I'm assuming it'll be pretty bad. It's going to be even worse for April. The jobless claims and the numbers I've heard are just off the charts. The thing that I look at also is the City Economic Surprise Index. And a lot of people say, well, you can't really market time with this. But what I can do is take the test or the temperature of economic strategists who put in these estimates for the data. And the economic surprise index in the U.S. is still really, really high. So we haven't seen the numbers come down fast enough. And usually when the city surprise index comes down fast enough, then you start to see, the bar is a lot lower, and then you start to see the economic recovery become a little bit clearer. So I still think that that's a risk, and it's going to take time.
We've got a credit issue that's going on a variety of fronts. I mean, there's REITs that are being liquidated. We've got businesses basically on the verge of bankruptcy in a lot of cases. And the problem here is that as we look forward, the expectations, kind of by the markets at the moment seem to be that, oh, well, this has just been a bad correction, but this is going to be over fairly shortly. But bear markets don't typically end in a single month.
Well, we typically don't see the type of reaction that we've had down in a single month either. It usually takes many months, sometimes quarters. It could even be years for real deep pullbacks to happen. Within the market, however, we're very technically oriented, you and I.
Right.
We can spot things or indicators when they get to levels where they're deeply oversold. I've had a lot of oversold indicators in the last couple weeks. I was short a lot of stuff. I bought a lot of stuff. I took some profits after a few days of 10% gains. I'll take those all day and night. And it's just my view is that the data from the virus is only going to get worse. If we see if you go to the headlines in Italy or Spain or Germany, the numbers are piling up. I hate to say that, but the numbers of deaths are increasing dramatically right now. And we really haven't seen that in the U.S. And the U.S. is a lot bigger than those countries. And I think that's going to cause more concern, more panic, more people to isolate themselves. Money's going to start to get tighter for many people, which it already is. I just think that we could see another move lower, maybe not that much more, but I think we're going to see a deeper pullback. That being said, what the Fed and the U.S. government have proposed and are starting to put into the process, stimulative factors right now, it's a ton of money. And I think that will roll into the economy, but it takes weeks. It takes weeks to implement bond buying structures. It's not going to be an overnight recovery.
You bring up an interesting point here, talking about the Fed's programs to basically bail out all virtual forms of credit. I mean, they're buying corporate bonds now. They're taking in bond ETFs. They're taking in corporate equities in exchange for collateral for loans. $700 billion in quantitative easing. We're talking about a massive expansion of the Fed's balance sheet towards $10 trillion. Now, we were at $4 trillion going into this. We're talking about expanding it by $6 trillion up to $10 trillion by the time this is all said and done. The interesting thing is when we talk about that is that debt outstanding increased in the first 3 quarters of 2019. Total debt increased by almost $9 trillion. So for a decade, they were providing zero interest rates. We've had this massive surge of liquidity, of debt across the board, whether it's corporate debt, household debt, margin debt, bank debt. I mean, it's just a massive increase in debt. The question to you is that yes, this money is going to come back into the markets from the Federal Reserve over time. Previously, it would wind up in equities because there was plenty of liquidity flowing around the market. Debt was easy to get. Debt was easy to transfer, buy and sell. My question to you is the problem with the credit market so large that it basically absorbs all of the liquidity coming in from the Federal Reserve and it doesn't filter back into the markets to elevate another bubble at this point?
Think about it this way. Are we just backstopping bad debt? Or are we making whole debt that shouldn't be made whole? It just seems to me that there's a lot of companies that have gone out and borrowed a lot of money, bought back stock with it, and now they're asking for bailouts. And you can go into the hundreds of major companies that have done this: airlines, cruise liners, IBM will probably, they bought back $75 billion worth of stock at about 40% higher than the price currently.
Yeah.
That's a bad allocation. So I think that there's a lot of moral hazard that's happening. I'm not going to be the, I hate the Fed type guy, but they need to come in when we do have these types of problems. The real issue that I have with the Fed is that they were giving away free money when they should have been more like the dad that took the credit card away from the college student who just rang up a $10,000 bill and had no means or way of ever paying it. You just have to have discipline. And the Fed, through Bernanke, Yellen, and Powell, I thought Powell was going to be that guy that was going to be the discipline, but they've just, they didn't want to upset the equity markets, thus the economy, and tried to keep the market cycle going for a lot longer than it probably should have. And now when you keep going longer, you're going to have a bigger bust.
I'm not a huge champion of Jerome Powell. I think he's made some critical mistakes. But I was on board with him when he was raising interest rates in 2018. He was starting, talking about reducing the Fed balance sheet. Those were the right actions. And then the market threw a hissy fit and he rolled over. And, I thought we had a dad in the room for a change in terms of a Fed chairman. I thought he was going to be the adult in the room. But it turns out he was, one of these dads who just puts the kids in timeout, right? And and instead we wind up with the children threw a tantrum, including the president of the United States, and he rolled over. And instead of letting the market correct back in 2018, yes, we were down 20%. It was terrible, but things were operating semi-normally at that point and could have eased ourselves into a better position financially rather than where we are now.
I think it's almost like the dad that took the credit card away but was still spending on his.
Yeah,
and
there you go.
It's the Fed and the central bankers have become so intertwined globally that, maybe Jerome Powell in December of 18 was maybe not reacting wholeheartedly to the U.S. market being down, but looking at other economies such as Europe and China, which was just getting beat down really hard, and thinking if they brought in some, they cut rates, that it would shore up everything, which it did. Obviously we had a year in 2019 that everything seemed to work. As much as people are saying, I hated 2019, I'll take you back right now any day. So that's kind of how a lot of people are thinking.
That's true. Well, let's talk about the markets here specifically from an investment standpoint. So, basically a 30% decline in the month of March. We're seeing a little bit of a rally as we head into the end of March. We've got a lot of quarter end portfolio window dressing that mutual funds need to do, et cetera. We're seeing that rally here. How far do you think this rally can go here? Do you think the bottom is in? And we did mention earlier that, you think another bottom is coming here, but, and more long-term in nature, do you think that it's possible we could see old highs again at any time in the near future, or are we going to be more range bound in this market for quite some time?
First of all, I've seen some positive divergences with momentum, with breadth. That's good. That's a good thing. But that basically will mean is we could see lower lows on some of the indices. However, the breadth and other indicators might not confirm that on the downside. I've had a target of 2100 on the S&P using a DeMark absolute retracement indicator. Mm-hmm. It's basically a Fibonacci retracement indicator. And I looked at that from the highs back in February, and I hit the DeMark guys and I said, are you seeing this? And they're like, man, we haven't even really looked at it, but now they are. And they're starting to be on board with that as well. And in 87, Tom DeMark ran the 87 absolute retracement on the Dow, and it was spot on as a level where we bottomed. I tend to think the market will chop around. It'll be rather violent. You could see a lot more up and down 10% moves. Those are tough to trade, and especially tough for portfolio managers. And I'm happy to do some tax loss selling on some positions that have not worked, and I'll book those. I may still like some of those companies. Actually, I do. One is Viacom. I think that stock's been beat down. Call it March Madness, the Masters, theaters. It's a perfect storm for them, but they're trading at something like 4 times earnings, which their earnings are going to go down a whole lot, but it's still the best value in media.
Yeah.
I think it's a great company, and insiders have been buying it all the way down.
It's a great point you bring up about the DeMark indicator on 2100, because I'm seeing a lot of the same things with the technical analysis I do as well. My question, though, is a little bit on the fundamental side. We're talking about 2100. We've got earnings on the S&P right now are still around the $130 mark. They haven't been revised down yet because a lot of guidance has been suspended by companies. So S&P is kind of waiting for that guidance to come in so they can start revising earnings downward. In relative events like this we've seen in the past, the average reversion in earnings is about 30%. So we're trading at 132. Let's make math really easy, and let's say we go down to $100 a share in earnings. At 2100, that's a 21 PE on the S&P 500. So now we're starting to talk a little bit about valuation. Does DeMark, I know DeMark is a technical indicator, price very much Fibonacci, and I use the same thing here. But at some point, do we have to start thinking about what price we're paying relative to forward valuations if economic growth is going to remain much weaker going forward because of all the debt?
I can tell you this. I am not a true fundamental analyst, but I went through level 1 CFA, and that was enough for me to understand enough, and I hate studying. So, but I will say that stocks are not going to be cheap at the lows, and you have to realize that, because of the damage that's been done is going to hurt earnings. So I think that you can almost throw out some of the earnings models. I think $130 on the S&P is more on the low end from what I've heard, but I don't know. I mean, guidance withdrawn is now the new catchphrase for companies to come out and say every single day, oh, we're withdrawing our guidance, because they don't even know. They don't know. They don't want to throw out something that they could possibly miss.
Right.
So I think that one of the things that I thought about was I remember the Bank of America CEO when the whole this after the subprime thing started to blow up and foreclosures were happening. He said foreclosures were sort of a taboo, but you're going to hear a lot more of that going forward. So you're going to hear a lot more of the guidance withdrawn, just because you don't know. And usually if somebody withdrew their guidance, the stock would get killed. We're going to have to watch for companies that bounce after guidance withdrawn, or they miss guidance, or even with economic data, if we bounce after really bad data. So that's going to be really a good tell for if we do get towards a bottom, that we start going up on bad news.
We're talking with Tommy Thornton from Hedge Fund Telemetry. One thing, as we've talked about this, right? We've talked about the debt, we've talked about the Fed, we've talked about the economy, and part of this economic recovery is going to be what areas of the economy can recover sooner than others. There's a lot of sectors like utilities and real estate that are under a lot of pressure because of the leverage they contain. We just saw recently the Invesco REIT actually being forced into liquidation and margin calls because of their issues. So are there areas of the portfolio that we should focus on more than others because of some of these issues?
I think you're right on the leverage. And that will all be pretty much a to be determined issue as these companies start to report, and we start to find out more about how companies are doing within this mess. I think anything that's over-levered has huge risk. I think you're seeing a lot of companies suspend dividends, stopping their buybacks. I think, to be quite honest, you want to find the companies that have the best balance sheets, that are still doing buybacks, that can withstand a lot of the short-term Short term for them is, a few quarters disruption. And technology still in areas has a great balance sheet. I mean, you look at Apple, Microsoft, even Cisco for that matter, and that one's beat down pretty hard. You can look at a lot of things out there that might be worth taking a shot at. What do you buy? Buy what everybody typically buys, and that I think will be played out again. If you go back 10 years from the lows in 2009, it's those same 5 mega cap names that keep showing up, and it's probably going to be that way going forward. And I'm not necessarily looking at them saying, oh, these are great bargains or anything like that, but I think that that's what people will gravitate towards. You want to have them in your portfolio when we bounce or when we bottom, and really start to base and move higher. Energy's been really tough, and I thought energy could have a move higher this year, and it still could, but it created a much lower level to start from, and a lot of those companies have really stretched balance sheets. Look at Occidental. I mean, oh my God, they bought Anadarko, and the debt they have is that's outrageous.
Yeah,
but they could survive. They're going to have to pull it in. Financials, I do like the financials. I like the big banks. I'm a buyer of Goldman. Anytime it's under 150, I think that's a place where you want to start to look at buying Goldman. JP Morgan, if it's just under 90 today, I think that's still a really good franchise, and it could have a little bit of turmoil over the next few months as they work out a lot of their credit card issues. Defaulting, probably that's going to be big. Citi's going to have the same issue. Morgan Stanley's a great franchise. I think that one can be bought. I don't know why they bought E-Trade, right? I think they should just jettison that idea.
Talk about terrible timing of making an acquisition. So
you always get those types of big deals at the top, and a lot of people will say, that just made no sense. And why are you buying a company that doesn't charge their customers for commissions anymore? It's going very, very low downstream for a firm like Morgan Stanley.
What about what we're talking about, kind of the major sectors, energy and technology, these type of things. What about industry size? So, for instance, one of my concerns going forward is that we could this economic damage could very certainly last longer than we expect. So, small cap companies, mid cap companies, those are more subject to economic weakness than large cap companies. And same thing for emerging markets and international. Kind of what are your views there?
Well, as far as the small cap and mid cap names, I think you're right. I think those companies will have exposed balance sheets, and you're gonna see some companies really just never get off the mat, and that's going to be troubling. If you look at the Russell, it's just blown away how far it's gone down. And I bought it recently, and I just sold out of it today, and I'm happy to take a little bit of a gain. But look, there's still a lot of unknowns that we'll start to find out in that group. As far as the emerging markets, I'm actually a little bit more positive on some markets. Like I'm looking at Mexico and some Latin American markets right now. They've been just absolutely crushed as well. And I also, but look at the EEM. It's basically a lot of China stuff, and a lot of China banks and Alibaba and Tencent. Is a big weight in that. I think those are going to be tricky. One positive thing that we should mention is China's starting to come back online, and that I think is not being discussed enough. And as they come back online, supply chains get back to normal or get back to work, and then that will trickle across the world, and once we get back online, then we'll see stabilization.
Well, and that also kind of bodes well for your energy theory as well, because they're a huge energy consumer. And if China does, and when, I shouldn't say if, but when China comes back online, that should bode well for energy consumption and start to increase incremental demand into that sector.
That's true. The energy complex has been just rocked by the difficult environment. Shale's been pumping out so much; they've had so much supply, and then you had the Russia, Saudi, OPEC plus spat, which that one I was sitting here at my desk on Saturday after the Friday bloodbath, and I see that Saudi Arabia announced that they were going to increase production, which is a huge. That was such a surprise. I looked at it going, holy. And it's been an absolute war on U.S. energy companies. I'm long Exxon and Chevron. I think some of the big ones are going to really, they'll survive, they'll thrive. But it's just, ugh.
Yeah. Well, it's a good point you bring up here. Is when we talk about, and again, this one went back to earlier, and people are going, well, this coronavirus is like 9/11. It wasn't just the virus. The virus was the trigger for all of the debt, all of the leverage, and then you throw on top of this an oil price war. And talk about doing stuff at the top. Saudi Aramco goes public, right at the peak of the market. This was this has been a collision of a debt crisis, a one-off economic shutdown, a impact to global supply chains. This is much deeper than just simply a virus. And I think there's too many people, it seems to me there's too many in the public media, public financial press, and kind of just investor sentiment in general, all assuming that this is the time to buy, we're at a bottom. And bear market bottoms aren't generally met with optimism. They're generally met with despair.
Yeah, you're right. We've had this pullback, I'm going to say crash, that had one 3-day bounce of 10%. And then it's been straight down, and it's been so swift that it really is unprecedented. I will say that, you have a lot of people out there that are really just looking, where do I buy? Where do I buy? And that's why I think if you're doing this, you've got to take profits when you have them. You can't be sitting there thinking I'm going to be a buy and hold owner of stocks at these levels. We don't know how long this is going to last. And the comparison with 9/11, this is like a little closer to home for people, because they are all scared. They're all out there hiding in their houses or not going out, staying 5, or 6 feet away from each other, social distancing. Grandparents and friends that they know or family members are possibly getting it, and dying. So it's scary, and scary is uncertain, and it's going to just get worse into April before it gets better. And we had Trump saying that he wants to reopen the U.S. Around Easter, and every medical official that I've seen or read have said that's way too early. So you're going to probably see that get pushed out a little further. And maybe he's just doing it to pump up the markets or instilling a little confidence. But
yeah, and look, I think it's good to have a little bit of confidence here. We need a little bit of optimism, a little bit of good news. But if you take a look at where we are in the cycle, we were talking about China a minute ago coming out of this. They're about 2 months ahead of us. In terms of where we are in the cycle. And, you brought up cases before, global total cases as of March the 25th was 438,000 total cases and over 19,000 deaths. In the U.S., it's 53,000 cases, 714 deaths. We're very early in this cycle relative to other countries that are already kind of further into this maturity cycle of the virus. So I agree with you. I think there's going to be, while we can be optimistic, I think we've got to kind of also tailor it to some rational expectations of what we're dealing with.
The thing is also, if you think back when China was really peaking the curve hadn't flattened yet. The news coming out and you saw these dire, phone videos of people getting hauled away in boxes or just being dragged in the streets because they were out. You don't know what's going to happen, and people in Italy and Spain and Germany have all been saying that it's gotten worse. And it gets to a point where there's a lot of hopelessness. And I don't think the U.S. consumer, the U.S. citizen is ready for that. I think people are not prepared for what's coming.
Yeah, I agree. Well, Tommy Thornton, thank you so much today. Thomas Thornton, Hedge Fund Telemetry. Be sure to get by his website, hedgefundtelemetry.com. It is a must-have investment service if you are managing your own money. I highly recommend it. Hedgefundtelemetry.com. Thomas Thornton. Tommy, thank you so much for your time today. We appreciate you and look forward to having you back on the show again soon. As we conclude our 2020 Investment Summit, we want to talk about the Fed, the QE, and of course, the prospects of how this all may work out. And for that, we touch base with Michael Leibowitz, CFA, and of course, the investment portfolio manager for RIA Advisors, and a credit market expert.